Your profit and loss statement can be completely accurate and still tell you the wrong story about your business. If you're making decisions based on your P&L, and I really hope you are at this stage of growth, there's something you need to understand about how those numbers are being prepared, because the method your accountant uses completely changes what the numbers are telling you. And most founders have no idea it's even happening. When I start working with a new business and take a look at their finances, the majority of them, and I'm talking 90% plus, have P&Ls that don't reflect what's happening in the business. And that makes it impossible to see the real patterns or performance. And therefore, it makes it impossible to make decisions. In this video, I'm going to show you the two different ways your accounts can be prepared, why one of them is essentially useless for making business decisions, and exactly how to check which method you're using and fix it if needed. By the end, you'll know how to make sure your P&L tells you whether your business model is working, instead of just feeling like a bunch of numbers on a page. So let's start with what's probably happening in your business right now. Your profit and loss statement has one job: to show you whether your business model worked in a specific time period. What do I mean by that? I mean, in January, did the revenue you generated cover the costs of generating it and leave you with something left over? That's it. That's what you need to know. Not whether clients paid you, not whether you had a big expense hit your bank account, but whether the value you created in that period covered the costs of creating it. That matters because your P&L is the tool that tells you if you're building something sustainable. It's how you know if your pricing is right, if your cost structure makes sense, if hiring that next person is affordable, if the business can support your life. Without a clear P&L, you're going to always be guessing. You might be busy, you might have money in the bank, but you don't know if the model underneath all of that activity is sound. And what I see all the time is founders who are working incredibly hard, delivering great results for clients, but who have no idea if they are making money doing it. They look at the bank balance and think that's the answer, or they wait until the year end when the accountant tells them what profit they made. But by that point, it's far too late to do anything about it. Your P&L should be showing you month by month what you earned and what it costs to earn it. That's how you make decisions with confidence instead of hope. But for your P&L to do that job, it needs to be prepared in a way that matches income with the costs of generating it. And that's where most businesses have a problem. So let me show you the two ways accounts get prepared and why one of them makes your P&L completely unreliable for decision making. The first method is called cash accounting. It's simple. You record income when money hits your bank account and you record expenses when the money goes out. It sounds neat, right? It sounds easy to manage. And for compliance purposes, for making sure you're legal and your tax is filed correctly, it works fine. But here's the problem. It gives you a completely distorted picture of performance. Let me give you two examples. Example one, you invoice a client in January, but they don't pay until March. Using cash accounting, January looks worse than it was. You did the work, you generated the value, but the revenue doesn't show up. Then March looks incredible because you got paid for the work you did 2 months ago. But neither month reflects what happened in your business. Example two, you pay your annual insurance bill in one go, let's say £1,200 in January. With cash accounting, January looks terrible now. That whole £1,200 hits your P&L in 1 month, even though it covers an entire year. The other 11 months shows zero insurance cost. So your P&L looks lumpy. 1 month you're apparently spending loads, the next barely anything. And it becomes very easy to draw completely wrong conclusions about how the business is performing. Remember, the job of the P&L is to show you the performance of your business in a specific time period. Cash accounting simply doesn't do that. It shows you cash movement, which is useful information, but it's not the same thing as performance. So all in, this is what lets you see, did the business model work this month? What did we earn? What did it cost to earn it? And what's left over? So if accrual accounting is what helps us see the true performance of a business, why is it likely that you're not seeing this in your accounts? Because most accountants and bookkeepers are focused on compliance, not performance. Their job is to make sure that your accounts are filed with the tax man, that you're paying the right amount of tax, and that everything is legal. And for those purposes, cash accounting is often simpler and perfectly adequate. So they default to it. Or they do a partial version of accrual accounting where they catch some things but not everything. You might see your insurance spread out, for example, but then your contractor costs are still lumpy, or your software subscriptions adjusted, but not other prepaid expenses. And the important thing to note here is that they're not doing anything technically wrong. They are doing exactly what they've been hired to do, which is compliance. But compliance accounting and management accounting are two different things. The second method is called accrual accounting, and it works very differently. With accrual accounting, income is recognized when it's earned and costs are recognized when they are incurred. So in that January example, where you invoiced a client but they didn't pay you until March, the revenue would show up in January on accrual accounting because that's when you earned it, regardless of when they paid. And that insurance cost gets spread over the 12 months it relates to. So instead of £1,200 hitting in January, you see £100 every single month. The result is that your P&L matches the income you generated in a specific period with the costs of generating it. It gives you a true picture of how the business performed in that period. In a service business, you'd apply the same logic to things like software subscriptions that you pay annually or contractors you bring in to help deliver client work. If you pay a contractor in February for work that they did across January and February, accrual accounting makes sure that each month shows the cost that it relates to, not just when the invoice got paid. Compliance accounting keeps you legal. Management accounting helps you run the business. And unless you specifically ask for your accounts to be prepared on a full accrual basis and to explain why you need that, you'll likely end up with something that works for the tax man but doesn't work for you. The problem is that most founders don't know to ask for this. They assume that because their accountant is handling the books, the numbers they're looking at must be reliable for decision making, but they're not. Okay, let me show you how to check if this is happening in your accounts right now. One place you can check is on your balance sheet. Look for accounts named accruals, prepayments, or maybe something like deferred revenue. I'll explain what these things are shortly, but for now, just see if they're there. If they aren't, or if they're always showing zero, that's a sign you're on cash accounting or only partial accrual at best. Then run your P&L by month for 3 to 6 months. Here's an example. You're looking for things like this. So even at a glance, we can see here that some of the costs are quite lumpy. Some of them look like they're double one month and then zero or a lot lower the next month. We can also see that some costs look like they're for an annual expense. And overall, this is making the P&L look really bumpy. These are the kind of things you want to look out for to understand how your accounts are being prepared. So if you find your accounts aren't being prepared on a full accrual basis, first, just have a conversation with your accountant. You don't need to be technical about it. Just say something like, I've noticed some transactions in my books look like they're being posted on a cash basis. For managing the business, I'd like to make sure everything is accrual based so I can get a clearer picture of performance. Can you let me know what it would take to make that change? Then give them the context they need. If you invoice clients up front for a few different months of work, tell them. If contractors work across multiple months before invoicing, tell them. If you've prepaid for annual subscriptions, tell them. They can't read your mind and they can't know the commercial arrangements you've made unless you share them. When they do the adjustments, I'd recommend asking them to do at least the past few months or your year to date so you've got a good run of numbers that tell the true story of your business. It might mean a little extra work, but it's really worth it for the clarity you're going to get. Now, when your accountant does this, they will start using the two types of adjustments I mentioned earlier, prepayments and accruals. Let me quickly explain what these are. These sound technical, but the concept is straightforward, and I'm not explaining them for the sake of it. Having this base understanding empowers you to have healthy conversations with your accountant and make sure you have clear financial information for making decisions. Okay, so not surprisingly, a prepayment is used when you've paid for something upfront that covers multiple months, like that £1,200 insurance bill in January that covers a whole year. Instead of hitting January with the full cost, your accountant records £100 in January's P&L and puts the other £1,100 to your balance sheet as a prepayment. It sits there as an asset you own until you use it. Then each month, another £100 gets moved from the balance sheet into the P&L until by December, the whole £1,200 has been recognised as an expense. This results in each month showing the cost that relates to that month. Simple. A similar mechanism applies to revenue. If you invoice $30,000 upfront for 6 months' work, $5,000 shows as revenue, and the other $25,000 sits on your balance sheet as deferred income, getting released month by month as you deliver the work. An accrual is the opposite. It's when you've had the benefit of something in a specific month, but you haven't been invoiced or paid for it yet. An example could be that you use a contractor in March to deliver some client work, but their invoice doesn't arrive until April. But the work did happen in March, so your accountant records the cost in March anyway. They accrue for it. That way, March's P&L shows the true cost of what you delivered in that month. These adjustments are what make your P&L match reality. And you don't need to understand the mechanics of how your accountant does this. You just need to know that without these adjustments, your P&L will be misleading. So those are the 2 accounting methods you need to know about: how to check your accounts and what to do if you believe they need adjusting. So go and check your accounts, look for those prepayments and accruals on your balance sheet, look for lumpy costs in your P&L, and if you spot signs of cash accounting, have that conversation with your accountant. Give them the context they need to switch everything over to accrual and adjust the past few months. Because once your accounts are running properly using accrual accounting, you'll be able to stop making decisions based on what's in the bank and start making them based on whether your business model is working. And that's what lets you scale beyond 50K months without simply working harder. You can finally see what's worth investing in and what needs to change. And if you're in the zone and you want to go deeper on accounts, grab my free guide to the one number in your P&L that matters if you want to scale a service-based business without burning out. The link to that is in the description below.